Hello, everyone, and welcome. Thanks for joining uh, BankSocial's first education event, Stablecoins 101, Compliance, Innovation, the Future of Financial Infrastructure. We have a lot of you on here today. We're excited to talk with you today. And really, this is geared towards an educational event to help you and your credit union or financial institution learn more about what's happening now with stablecoins. This isn't a future use case, what's happening today. We're going to address legislation a little bit and talk about what some financial institutions around the country are doing. So glad to be. I'm Andy Fogel, Director of Sales at BankSocial. We're joined by Becky Reed, who you'll be hearing from a lot. Becky is the COO of BankSocial. She spent more than 25 years in the credit union industry. She's a co-founder of multiple CUSOs, was the board advisor and the NCUSO chair emeritus. And she's been an emerging technology enthusiast for many, many years, and excited to talk to you about that today. She's also an author, publisher of the book Credit Unions and DeFi, or her book Credit Unions and DeFi was published about a year ago. And love to have you pick that up on Amazon if you want to learn more and take just one step further than what we're talking about today. So before Becky gets started, just a little bit of housekeeping. If you want, we want this to be interactive. We want you to be able to ask questions as we go. And so feel free to comment on the video. We'll pick up those questions and ask a few questions throughout. You don't have to save those to the end. You can ask those whenever you want. And then, but we will save a little bit of time for questions at the end as well. So without anything further from me, Becky, go ahead.
Hi, everybody. So thank you, Andy, for that wonderful introduction. And Sarah, if you'll move to the next slide, please. All right. So this is me. Andy talked a little bit about my book. It's there in the corner. And yes, you can pick it up on Amazon. So one of the things that I noticed in about 2015, when I was at Lone Star Credit Union and I was implementing a technology infrastructure with the CUSO we started, Pure IT. And I noticed decentralized networks, right? I thought that was really interesting, blockchain being a decentralized network. And while I didn't really care much about Bitcoin from an investor perspective, I did see that it was going to be a disruptor to traditional payment systems. Because coming from a financial institution and understanding how payment systems actually work behind the scenes, right? They're batch, they are siloed, they're clunky, they're rife with fraud, and they're not real time in most cases. And so I really saw Bitcoin initially as something that was going to disrupt what we do. Well, then when I started learning more about the decentralized finance movement, it reminded me very much of the credit union movement. And so that's why I wrote the book. And of course, I joined BankSocial in 2023 after Lone Star Credit Union piloted some of our initial products. And CUSO enthusiast. And so today we're going to dive into stablecoins and how this is disrupting traditional payments today. All right. What do we really do in a financial institution? Well, what we do is facilitate payments for our members or our customers, depending on if you're a credit union or you are a bank. Even lending. So a lot of people say, well, credit unions make loans. Yes, but why is somebody getting a loan? It's usually to pay somebody else, right? To buy a car, to buy a house, to do something. Even if it's a credit card loan, you are using that to pay a merchant. And so at the financial institution, what we do for our members is we facilitate that process, right? Their direct deposit comes in or their income source comes into the credit union. And that checking account is the means by which they pay other people and live their life, right? Well, remember I talked about the payment system behind the scenes and the credit union is kind of clunky and batch and not great. Well, this experience that you're seeing here on the screen is a real experience. That is a real app behind there. And it's talking about this is the member experience. So anytime members want to send money in real time, or maybe they want to this here for you, Sarah, because you might be able to hear those things, those pop-ups coming in on my screen. So the payment experience for your member is clunky. I referenced an account that my husband was opening at another institution. You guys would probably recognize it, but I won't say their name here. But he was opening an account somewhere else because they paid a higher dividend on a money market account. And it was an online, completely online bank. And I was like, good luck with that. Moving the money there is going to be painful. And guess what? It was. It took him 6 weeks to get money from our credit union, where he had most of his money at, to this online bank, which you would think would be a lot easier, right, than a traditional financial institution. Well, it wasn't easier because our payment systems are clunky. Now, many of you might say, well, how is cryptocurrency playing a part in this? Isn't that like gambling, right? Cryptocurrency, you've got Dogecoin, you've got Trump token, right? There's all this crazy uh, hype around, pump and all this verbiage that is like, why would a credit union want to get involved in that? And do we really want our members to be involved in those things? And so I want to explain a little bit the difference between cryptocurrency and stablecoin. So what exactly is cryptocurrency? Well, crypto in the word cryptocurrency stands for cryptography. Cryptocurrency is digital money or a representation of value that people can use. They can buy it, they can hold it, they can send it to each other. And if somebody will accept it as payment, it can certainly be used for that as well. There's also other things that cryptocurrency can be used for. Tokenizing real world assets, which could be used as money as well, right? But cryptocurrency itself is something that rides on a distributed ledger. DLT is the generic term for the technology behind blockchain. Blockchain is a type of distributed ledger. There are many different types, and it just is really a database at the end of the day. And blockchain is a description of how data gets encrypted and stored on chain. That's really all it is. And we all are very familiar with databases, right? We use a database, a centralized database at our financial institution that's called the core. Now, cryptocurrency is the mechanism by which transactions move on chain. And so many of you, from a cryptocurrency perspective, may have heard of all of the different kinds of cryptocurrency that are out there. The difference between traditional cryptocurrency that many of you would recognize today, like Bitcoin, like Ethereum, is that it doesn't have a stable value. The value depends on trading. So kind of like traditional stock, the volume and the trading and the value may go up and down. So because of that, most of the time, people don't want to use something that is volatile as a payment. So now let's step into what a stablecoin is. A stablecoin is pegged to fiat currency, meaning it is going to have the same value as that fiat currency, like a US dollar, has out there in the world. So it's a digital asset that is pegged to the value of a fiat currency. So a stablecoin is designed to have the same value as the money that's backing it. So in this case, we're going to talk about US dollars. And so stable coins that are backed by US dollars are something that is more akin to a traditional payment that you would make because you're making that payment in US dollars. It can also be referred to as a digital dollar, a payment token. That is what the Genius Act refers to it as. But by utilizing the distributed ledger rails in a decentralized way, or the blockchain rails, you can use stablecoin as payment. And from an end user perspective, it feels very similar to just making a payment with your Apple Wallet, for example. You go in and you tap to pay, and that money is then transferred via usually a card that you have connected to that Apple Wallet to the merchant. Well, a stablecoin works in a very similar way. For those of you who are in the webinar that are cryptocurrency enthusiast, you have cryptocurrency, you have a digital wallet, you know firsthand, like I do, how easy it is to move that money from wallet to wallet. And that could be a P2P transaction. So it's very simple for me to take a piece of a Bitcoin or Ethereum or whatever cryptocurrency it could be. It could even be a stable coin. And I owe my friend for lunch to send $5. Instead of tapping to pay at a merchant, I just scan a QR code for their wallet. And that digital asset is then transferred from my digital wallet to their digital wallet. And that is why this is a complete disruption to payments today. And this is why financial institutions need to be paying attention, because your members, absolutely, if they are not already doing this, are going to be doing this. And this will become very prevalent in the United States soon. It is already very prevalent throughout the world. The most popular stablecoins in the world today are USDC and USDT. USDC Circle is the company backing that, and USDT is Tether. Tether is the company backing that. USDC is more popular here in the United States. USDT is more popular globally, particularly in developing countries. All right, next slide. All right, the Genius Act. So I went to a conference recently and I was speaking on the future of payments, and the Genius Act had just passed the Senate the night before. I was speaking to finance professionals and I asked the room, has anybody in here heard of the Genius Act? Only a few people raised their hand. So this is not on our radar in general in the financial institution space, and it absolutely needs to be. So the Genius Act came out of the Senate Financial Services Committee and it made it out to the Senate floor, and it was actually approved by the Senate. And so now it has been kicked over into the House. So what exactly is the Genius Act? So of course, our government likes acronyms, kind of like credit unions and banks like acronyms, right? Guiding and establishing national innovation for U.S. stablecoins Act. It is very important for the United States to have a regulatory framework around how US dollar backed digital assets might work, especially as it relates to consumer financial protection and the backing of those digital assets and how the reserves are used, the regulatory authority over who would regulate the issuers of a stablecoin. And that is what this is all about. Once it passes the House and it becomes law, then all of us in the United States will need to follow that. But I'm going to say it legitimizes the industry, particularly for financial institutions, which are very highly regulated, which might be averse to utilizing stablecoin technology or digital asset technology in general because of the regulatory framework. There's some ambiguity there. So who can issue stablecoins? Well, according to the Genius Act, now this has not become law yet. Certainly some things might change before it gets passed by the House and becomes law and signed by the president. But the issuers for stablecoins can be banks and credit unions. It could be non-bank entities, non-depository institutions. It can be companies owned by banks and credit unions, like a QSO, and it can be large technology companies. However, there are some regulatory frameworks around the large technology companies, what they might be able to do. They generally are going to need to partner with a regulated issuer. Now, many of you might be saying, what? A credit union or a bank can issue a stablecoin? Yes, the Genius Act does allow for that. I don't necessarily recommend that credit unions go issuing stablecoins. We generally are not ready to take on that kind of risk. However, a third-party technology company, a fintech or a QSO, would absolutely be the right choice for a credit union to utilize, especially early on in the process. A lot of banks are looking at what's called tokenized deposits, and I'll get into that here in a minute. But a payment token, a stable coin, and a tokenized deposit that a bank might issue or a credit union might issue are different things in how they are reserved for and how they might work for a consumer. Okay, next slide. And Andy, I'll stop right here for a minute. Are there any questions that have come through?
Yeah, I believe there are. Let me look here. I think you can just go for now. There are some questions coming in. We'll get those here in just a moment.
And I have muted you, so maybe I muted you there. Did you say
Go
something?
ahead. You can go ahead. I think there's some more questions coming in, but you can go ahead for now.
Well, are you sure? I see one that came through. It wasn't really a question, but talking about in Europe, crypto assets instead of cryptocurrency, it's called crypto assets. So that's kind of an interesting thing. But I'm sorry, I muted. Did you have a question? I can go ahead and answer it.
No, not right now. Go ahead.
All right. I spoke earlier about the fact that stablecoins are on the rise globally, and this is a very sobering statistic. So you'll see there that my reference there is visachainanalytics.com. So Visa is paying very close attention to this, as they should, because stablecoins are much less expensive and very, very fast to move money globally. Visa obviously has payment rails that moves money globally, and so they're paying close attention to this. In the last 30 days, there have been $4.1 trillion in stablecoin transactions that have happened around the world in the last 30 days. Much of that is in Tether or USDC. There are some other non-US dollar backed digital assets, stablecoins that are out there, but the most popular are US dollar backed. And the reason being is that a lot of folks in developing countries around the world prefer to hold US dollars because US dollars tend to hold their value better than the currency in their particular country. Here in the United States, we already use the US dollar, and certainly it has a stable value. We can trust that when we go to the grocery store, for the most part, that inflation isn't going to happen overnight. In a lot of other countries around the world, there can be political unrest, there can be a regime change, and so the currency in their country is extremely volatile or has the potential to be extremely volatile. And so people prefer to hold an asset that is more stable. And Tether generally is what's used around the world. So the pictures here on the left-hand side of this is actually a duty-free store in an airport in Latin America. And you'll see there that USDT, where it talks about USDT 22, and I know that seems like a really expensive Oreo cookie package, but that USDT is Tether. So the duty-free store in an airport in Latin America accepts Tether as payment to buy things. And that should be eye-opening to all of us here in the United States, to mean that all of us who are asking, what does this really mean for me? Is this something I need to pay attention to? 100% absolutely. $4 trillion, that's double the asset size of the entire credit union ecosystem in the United States every month is transacting in stablecoin globally. That is something that we need to definitely pay
Becky, we do
attention
have a
to.
question, and I think
Any
I
questions?
think you might address it on the
Great.
next slide, but keep this in mind when you're going through this. As in your opinion, is the future of payments stable coins or something closer to tokenized deposits? Given the climate in the US, stable coins are the preferred medium, but it seems like tokenized deposits would be less of a barrier to entry. So as we're talking about, and it looks like your next slide actually is talking about stable coins versus tokenized deposits. So if you can comment on that too, what's the difference and why should credit unions care about that?
Right. Well, all a tokenized deposit is the bank taking that dollar that's sitting in the customer account, turning it into a digital asset and giving that to their customer in a digital wallet for them to go spend on DLT rails. A stable coin is very similar to that. Both of them are backed by a US dollar. A stable coin would be issued by a private issuer, and a financial institution would allow their member to hold that in their digital asset wallet that is connected through to their digital banking. So really, from a consumer perspective, for the most part, it will feel very similar. To the financial institution, however, it might be quite different on how it works on their balance sheet. So again, this is not covered in the Genius Act regarding tokenized deposits, but the requirement of a stablecoin issue to actually hold the dollars somewhere. So on a private stablecoin issuer, for example, let's say that BankSocial issued and actually we have a company that does this. The Rivia stablecoin is a stablecoin that consumers can buy, and that is backed by real dollars sitting in a credit union. So that's called a proof of reserve account, and it's one-to-one backed. So for every token that's issued, there's a dollar sitting in a credit union behind the scenes. Similarly, if a bank issues a token, that dollar has to always be represented there as well. So my dollar has to be sitting there. The bank would have to set that aside, and then once that token is used, then it would come back, be redeemed for the dollar, and burned. So in a lot of cases, a tokenized deposit might be considered insured by the FDIC, whereas a privately issued stablecoin may not be considered insured by the FDIC or the NCUA Share Insurance Fund. Again, there is nothing in the Genius Act that talks about this specifically yet, and so there's no regulation around it. I do happen to know that a lot of financial institutions and the regulators in Washington, D.C. are paying very close attention to this, but really that's the difference. A privately issued stablecoin would be a regulated issuer under the Genius Act and all of the framework that is required there. The dollars backing it can also be in U.S. Treasuries. That is allowed for in the Genius Act, and that is how USDC works today. They have some in dollars sitting in a financial institution and some in U.S. Treasuries. And there's auditable auditability requirements that are in the Genius Act as well for issuers. But right now, that is kind of the difference between a stablecoin, privately issued stablecoin, and a tokenized deposit that a bank might issue. All right. Another reason to pay attention. You guys might have heard that Fiserv recently partnered with, they may have acquired them, a company to issue stablecoins. And now again, Fiserv is a payments company, right? Certainly they do other things. They provide core banking services and things like that. But they also have a pretty major payment rail, right? And so, of course, they would be interested in utilizing payments on distributed ledger rails, i.e. stablecoins. Of course, X has been looking into this. PayPal already has a stablecoin. Airbnb, I found out, was looking at doing this. Of course, all of the giant fintechs out there are looking into this. Bank of America actually issued a white paper on tokenizing deposits that's quite interesting. Google is taking a look at using payments. Now, you might also ask, how does AI play into all of this? And AI and the payments ecosystem that is happening on distributed ledger rails go hand in hand. So as an example, I was talking to someone that was using ChatGPT to find some shoes that might help his knees. So he liked to play basketball. He was getting older. When he played basketball, his knees would hurt. And so we asked ChatGPT, what would be the best kinds of tennis shoes to help my knees because they hurt when I play basketball? ChatGPT found several different basketball tennis shoes that had cushion that would help his knees whenever he played. And it gave him the links to websites where he might go and research and find out which one is best for him. Very soon, that ChatGPT might ask, hey, would you like me to go ahead and buy those for you and have them sent to your house? You can have a personal AI that would do that. And you might allocate stablecoin in order for the AI, your personal AI, to be able to go out and buy those things, because these are all digitally native technologies. AI is digitally native. Distributed ledger technology, where stablecoins live, also digitally native. So it makes sense that the two would actually work very closely together. Any other
Yeah, Becky,
questions
we
come
do have
in,
a couple.
Andy?
It's kind of a two-part question here. One, are members going to need a deep dive training to figure out how to use this? And two, how can financial institutions make this an opportunity to serve their members and customers?
Yeah, great questions. And the first one, I get this one a lot whenever I go out and I train boards. So I educate board of directors at financial institutions, credit unions, and banks, and teach them about these kinds of things. So this is a very similar type of format that I would bring to a board to talk to them about. And one of the questions I do get is, how in the heck are members going to even understand what this is? Well, I think many times in the credit union industry and in banks too, we tend to focus on the underlying technology. Well, would any of your members be able to explain how ACH works? Would any of them be able to explain what really happens when they swipe their debit card? Well, probably not, but they still use it every single day. So the member experience is what's going to make this easy for members to use. So just like I mentioned that tap to pay, the customer experience, the member experience is going to feel very much like any traditional payment that they are using today. The difference being is it's going to be faster in some cases than what they are using today. The settlement time will be much, much quicker. It'll be in real time, unlike a debit card transaction that might take a day or two, or an ACH transaction that might take a couple of days, 3 days. This will happen in real time. There's also some really great fraud and risk mitigation capabilities that happen on chain that just are not available with traditional payment systems. Don't have time to get into that now, but all of these things will be working behind the scenes for your members. But I can tell you, to use it, you don't have to understand the underlying technology there. And then the other question, Andy, remind me. I think you're on mute.
Sorry about that. How can FIs make this an opportunity to serve their customers? And then we also had a question on what role BankSocial will play um, in providing this to institutions to give to their customers.
Right. Well, I think that it's very important to make sure that you offer the kinds of services that your members are going to need in the future. And the functionality of a stablecoin and as a new payment rail creates opportunities for cross-border payments, for example, that is just really clunky and expensive and hard to use today. And uh, digital assets can be transferred around the world in real time, 24/7, not just in banking hours. And so there are lots of opportunities for credit unions and banks to provide these things to members. And what I'm going to tell you a little bit later, which is I think on the next slide, is digital wallets are going to become the new digital banking. So a digital wallet is where you can store digital assets, but a digital wallet can also be a place where, if it's connected to your core system, your members will be able to see all of their financial life, basically all in one place in a digital wallet. So they would be able to transact on digital asset rails, DLT, blockchain, using stablecoin, or they would be able to use RTP and FedNow, which are real-time payment rails that are better than some of the legacy systems like ACH that are more prevalent today. They might even be able to have their stocks in there, have account aggregation where they can see multiple accounts. So digital wallets will kind of become the digital banking, which digital banking today is one financial institution, and that financial institution controls the entire experience. And so as we move into the person first digital experience, which is a Web3 world where the consumer, the end user, is the one deciding what their experience will be, we will move more into a digital wallet space as opposed to just a siloed digital banking that is very centralized. And so the way that BankSocial can assist financial institutions in moving into this new world is we can give your members access to distributed ledger rails. So yes, we have a digital asset exchange where members can buy and sell cryptocurrency in an investor kind of a way, similar to how people buy Bitcoin or Ethereum, which are commodities, but they do that today in their digital asset wallet. And so giving them access to those rails allows your members when they're ready and when you're ready to be able to use uh, payment tokens or stable coins as payments. So BankSocial can help with that. Anything else before I finish up?
No, that's it. Next slide, Sarah.
All right. How do you start? This is what I get a lot of times whenever I go and educate boards around this. They say, what in the heck do we need to do to get started? Because it can sound overwhelming. And a lot of times, the best way to understand an emerging technology is to use it yourself. So, first of all, educate your leadership team and your board so that you can start understanding some of the technology. You don't have to do a deep dive. Again, we don't have to go in exactly how a batch process works for ACH, but understanding how a decentralized network might differ from some of the centralized networks that we are using today. And then, guys, use it yourself. Buy some digital assets. Certainly, you can download the BankSocial wallet. You can buy some stablecoin. You can hold it. You can transfer that around your credit union. You buy $10 in stablecoin and move a couple dollars in between each other to see how that feels, because that's how a P2P experience is going to be utilizing digital assets. You can go and, some of the popular exchanges out there, there's crypto.com, there's Kraken, there's Coinbase, all of those kinds of things. If you would like to just experience purchasing cryptocurrency in general from an exchange, that's another way that you can do it. But it's really hard to understand how it might be used by your members who are using it now, by the way. If you pull your data, you will see that there's a lot of deposits that are going out to digital asset exchanges. So your members are actually purchasing this. And so it's really important that you at the credit union at least understand how it works. So just try it and use
Becky,
it
we had a
yourself.
question here. How can a credit union or a bank educate their board? What's the best way to start to do that?
Well, if you feel like you're not the best person to educate them, maybe you're not the subject matter expert in the space. So similar, whenever you are trying to help your board understand board governance better, you probably are going to bring in somebody who's an expert in compliance or a legal expert that understands the credit union regulations around board fiduciary responsibilities, things like that. Training your board on BSA, the Bank Secrecy Act. Sometimes there's a subject matter expert at your credit union that provides that board training and staff training. Sometimes you bring in other people from outside. So I would recommend providing training for your board from a subject matter expert. Certainly here at BankSocial, we can help with that. It's not a sales pitch. We train your board similar to what we are doing right here. And if it's an in-person interaction, we can also do it remotely. But allowing people to ask questions in a way where they feel safe is really important. So that's the best way I would recommend educating your board and your leadership team.
We're nearing the end of the presentation. Just to let everyone know, we do have some more questions coming in. So if you have any more questions, feel free to go ahead and drop them now. We'll get to as many of those as we can. We do have a couple more, Becky. One, is there a potential problem if too many institutions issue their own stablecoins? And is there an opportunity for credit unions or financial institutions to come together, like with shared branching, and issue their own?
Well, I think, and I say this all the time, collaboration is our superpower in the credit union space. And I think that sometimes we wait too long and we wait for the big players to go ahead and move forward with some of these emerging technologies. And then we just buy it from them or use what they have already built. I think that one of the most innovative things that have happened in the credit union space is the shared branching network. But it's a little antiquated, it's not updated, it's a little bit of a clunky system, but there are thousands of members and credit unions that use it today. So I think that having a stablecoin network where intra transactions can happen or inter, so credit union to credit union transactions, because your members are sending money to other members at other credit unions. And so it makes perfect sense to me to have a shared branching network with a stable coin that all of the credit unions would be willing to accept. Now, the other question is around there's going to be 1,000 different stable coins, and how do we know which one is the best one? And what if some financial institution or some merchant only takes a certain kind? So there is a process behind the scenes that will happen, and of course, BankSocial will comply with this, but lots of others as well. And it's interoperability. And so what that means is one stablecoin can turn into another stablecoin behind the scenes in real time. Your member wouldn't even know that it's happening. So for example, if a JP Morgan customer comes to your credit union and wants to make a deposit in a stablecoin, it would be really simple for the third-party service provider that facilitates that payment transaction to turn that JP Morgan token into a credit union stablecoin token and deposit that into the credit union. So interoperability and all of that will happen behind the scenes. Now, this is my opinion, but I predict that in the next couple of years, we're going to see an explosion in stablecoin issuers and tokenized deposits. And so kind of like at the beginning of the internet, where everybody just built a website, right? And there was 1,000 different websites for 1,000 different things, and there was just a lot of noise in the space. I think we're going to see that happen initially, and then things will kind of calm down and will consolidate a little bit, and there will be the more popular ones. But a US dollar-backed stablecoin, regardless of if it's this name or that name, it will be interoperable and will be able to be traded amongst each other.
And Becky, what role do stable coins play in the lending process with banks and credit unions?
Well, I mean, it facilitates payments, right? So right now, today, let's take a car loan, for example. And certainly, car loans and loan applications in general all will be moving on chain as well as we go into this Web3 digital native world. But let's just use a traditional loan right now. So the proceeds from that loan generally get wired to a car dealership, right? So there's a whole process that happens behind the scenes, right? So the loan gets booked, then the wire instructions go out, the people in accounting have to send that out. They might only send them once a day, they might only send them once a week. And so the car dealership, on the other hand, is waiting to order that title and to put the lien on the title until they get the wire from the financial institution. And so utilizing a stable coin, all of that would go away. And as soon as you hit the button to book the loan, that money would be sent to the dealer right then.
And we have someone that's got a couple questions here, so we'll just kind of do them one at a time. First, what size of credit unions should be actively looking at this technology, either with BankSocial or just this technology period? That's the first question.
Any size credit union. Again, I'm a small credit union enthusiast. I came from a small credit union background, and this is not super complicated technology as long as you partner with the right fintech. It is not super expensive technology, and so every credit union can afford it, and every member and consumer should have access to this technology.
One thing I'll add to that is Becky and I both have a background as being small credit union CEOs. And one of the things that frustrated me when I was in that role was I would get often priced out of technology and couldn't afford it. That's certainly not the way that BankSocial works, or this technology period should not work that way. So any size credit union, we right now work with credit unions from literally that have a few hundred members, and some that are even working on some maybe new charter credit unions, all the way up to credit unions with a couple 100,000 members. So we can work with any size. The next question, Becky, that person has is, does it work with any core? And is there a separate app that members would need to use?
Yes, it can work with any core. But really, at the end of the day, you're connecting directly your members to the distributed ledger rails on the back end, and that happens through digital banking. The money movement certainly would happen in your core, but yes, any core, any digital banking, or it can be a standalone app as well. So any of those things or all of the above. I see too, there's a question here, I'll just answer it about, is CBDC dead? That's central bank digital currency. And no, I don't believe that it is. I think that central bank digital currency has a use case for like the Federal Reserve moving money back and forth. I think that it makes sense in certain use cases. I don't think CBDC makes sense in a consumer use case for consumer payments. Again, this is my opinion.
Got it. I think if there are any more questions that we have coming in, I think we've addressed many of the ones that are in here right now.
Okay. Well, thank you guys all for tuning in. We hope to do this educational series more often, so be on the lookout for more of these. Thank you so much for being here. So I'll reiterate, educate your leadership and your board, use this technology yourself, even if it's just for a couple of dollars, and put this on your planning calendar for the next 12 months to get started as soon as you can.
All right. Thank you guys. Appreciate it.